Have you ever seen a stock jump 20% in a single day? Or collapse 30% overnight? Many beginners think these moves happen randomly. They don't. Behind many of the market's biggest moves are catalysts, events powerful enough to change investor expectations. And among all catalysts, one stands above the rest: earnings reports. Today you'll learn why earnings matter, why markets react so aggressively, and why understanding catalysts can help you think like a professional investor instead of a spectator. Let's begin. Public companies report their financial results on a regular schedule, usually every quarter. These reports provide insight into how the business is performing. Revenue, profit, expenses, growth, cash flow, future expectations. Think of an earnings report as a company's report card. Investors are constantly asking, is the company growing? Is management executing? Is the business becoming more valuable? Earnings reports help answer those questions. And because investors care deeply about those answers, prices often move dramatically when reports are released. This is where many beginners become confused. A company can report record profits and the stock falls. A company can report disappointing results and the stock rises. Why? Because markets care about expectations. Imagine a student expected to score 95 out of 100. Instead, they score 90. The result is good, but below expectations. The market often thinks similarly. Professional investors constantly compare reality against expectations. This is why understanding expectations is just as important as understanding results. During earnings season, professionals focus on several key areas. Number 1, revenue. How much money did the company generate? Number 2, earnings. How profitable was the business? Number 3, guidance. What does management expect in the future? Number 4, growth. Is the company expanding? Notice something important. The future often matters more than the past. Markets are forward-looking. Investors care about what might happen next, not only what happened yesterday. Many beginners focus only on earnings. Professionals pay close attention to guidance. Guidance is management's outlook for the future. Imagine two companies. Both earn $1 million. One expects rapid growth next year. The other expects significant challenges. Which company would investors likely prefer? The future drives valuation. This is why a strong earnings report can sometimes be overshadowed by weak guidance, and vice versa. Earnings are important, but they are not the only catalysts. Markets also react to interest rates, inflation reports, and economic data. New products, acquisitions, regulatory decisions, geopolitical events, industry developments. Professional investors constantly monitor these factors because they influence expectations, and expectations influence prices. Before earnings, uncertainty exists. Investors disagree. Some expect good results, others expect disappointment. When earnings finally arrive, uncertainty decreases. New information enters the market. Investors react. Institutions adjust positions. Analysts revise forecasts, and volatility often increases dramatically. This is why many stocks experience large price gaps immediately after earnings announcements. The market is rapidly updating expectations. Professionals rarely react blindly. They prepare. They know when earnings are scheduled. They understand the company's history. They review analyst expectations. They evaluate risk. Most importantly, they understand uncertainty. Professional investors do not assume they know what will happen. Instead, they prepare for multiple possibilities. This mindset improves decision-making. Many beginners make the same mistake. They see excitement. They hear rumors. They place oversized trades before earnings. And then they are surprised when the market reacts differently than expected. Remember, even if you correctly predict results, the stock can still move against you. Because markets respond to expectations, not just outcomes. This is why risk management remains essential, especially around major catalysts. Professionals understand something powerful. Catalysts create opportunity, but they also create uncertainty. The goal is not predicting every earnings report. The goal is understanding how information influences markets. Because every major move begins with changing expectations. And understanding expectations helps investors understand behavior. Stocks do not move only because of charts. They move because businesses change, expectations change, information changes. Earnings reports provide one of the clearest windows into those changes, and investors who understand catalysts often see markets differently. Choose 3 publicly traded companies. Research their next earnings date, recent revenue growth, recent earnings results, future guidance. Then ask yourself, what expectations might investors have? Begin thinking beyond the chart. Today you learned why stocks make some of their biggest moves: earnings reports, catalysts, expectations, and changing information. Tomorrow we'll study sector rotation, one of the most important concepts used by institutional investors to understand capital flow. Subscribe to Wealth Entertainment 21. Turn on notifications. And remember, markets move when expectations change. Learn to understand expectations, and you'll begin understanding markets on a deeper level. I'll see you in episode 20.